Students, I am going to discuss with you a topic titled Share Capital under the unit Company Accounts. This is for CA Foundation course, the accountancy paper. Let me give you a brief background, especially to those of you who haven't heard the term share and share capital. What do shares mean? Shares, according to the Companies Act, is a part of share capital of the company. Now, what does it mean? Every business organization, and company is a business organization, requires money, finance, which is called as capital. To raise this capital, the company, under the law, the called Companies Act 2013, permits a company to raise capital either from its members, called share capital, or as a loan from outsiders, called a debt capital. We are in this topic, in accounting treatment, we are talking about share capital. So therefore, shares would mean a part of the total share capital of the company. Shares is a security. So a security is issued by the company to the persons who agree to contribute buy shares of the company. To give an example, a company wants to raise 10 crores of rupees as capital, maybe to buy machinery or buy inventories, etc. Now this 10 crores of share capital is divided into equity shares of rupees 100 each, which means roughly about 10 lakh shares, 100 each, it becomes 10 crores. So there are 10 lakh shares, each share value rupees 100. 10 lakh into 100, it becomes 10 crores of rupees. Now, so this share, which is a value of 100 rupees per share, is given in the form of securities. So if a person applies, purchases, say 100 shares, so the share certificate will say that such and such person holds 100 equity shares of rupees 100 each in the share capital of such and such company, signed by the company. Now this is what do we mean by shares. Before we go ahead how the share capital is raised, let me explain to you some important terms regarding share capital. You must remember, while you prepare the balance sheet of a company, the company is bound to disclose the forms of capital: authorized capital, issued capital, subscribed capital, and paid up capital. What is the authorized capital? Every company has a document called Memorandum of Association. It is a birth certificate, legally known as incorporation certificate. Now that Memorandum of Association has a class, as a chapter, known as capital class. Now that Memorandum of Association describes the company as entitled to raise so much of share capital, which is known as authorized share capital. It will be a high figure. Throughout the lifetime of the company may raise that capital. Say for example, company authorized capital is say 1 lakh crores. Now obviously no business will require 1 lakh crores at a point of time. Immediately it may require 100 crores. After 4 years it may require 200 crores, another after some time maybe 10,000 crores. So authorized capital is the maximum amount of share capital the company can raise. Alright. It tells you the total value of the authorized capital divided into shares of 100 each, 10 each, 1000 rupees each. It can have shares of different denomination, face value. 10 rupees share, 100 rupees share, 1000 rupees shares. Since it is like a commodity to be sold to the investors at large, the public at large, so the company fixes the face value very carefully, keeping in view that it can easily be sold. Now that portion of authorized capital which a company issues to the public, issue to the members, allots to the members, it is known as issued share capital. Obviously, if a company has got say 1 lakh crores of authorized capital, it cannot issue more than 1 lakh crores of rupees. So at a point of time, as I told you, it may issue 10 crores of rupees. After some time, it can issue 100 crores of rupees. Then it may issue 50 crores of rupees, depending upon its need. So as the need goes, it issues capital, and the issued capital ultimately will total to the maximum amount of authorized capital. Now, issued capital must also be shown in the balance sheet. Every time balance sheet is prepared and signed. Now, what is issued capital? Issued capital is a share capital which the company is offering to the public, to the members, to the investors to buy the shares. Now, the public may buy, may not buy, may buy 50%. So that portion of issued capital which the public agrees to pay or buys, the members contribute, it is known as subscribed capital. I have subscribed to you. The company by issued capital offers to the public and the public buys it. The investors buy it. Now, having understood subscribed capital, let's say for example, company issues 1 lakh shares of rupees 100 each. So it will be 1 crore rupees. So 1 lakh shares of rupees 100 each. The public may buy 1 lakh shares. Obviously, it cannot buy more than that. Subscription can be 1 lakh shares, 90,000 shares, 95,000 shares. So it depends upon various circumstances. If it is a new company, it may be just subscribed, but it is a well-known company like Tata's, Reliance, etc. There can be even oversubscription. Even if there is an oversubscription, company cannot issue shares more than what it is issued. So subscribed capital cannot exceed the issued capital under no point of time. So we shall see what happens to the oversubscription excess. Suppose 1 lakh shares are issued and you get people ready to buy 1.5 lakh shares. So you have to allot 1 lakh shares among those applicants of 1,50,000 shares on some well-designed formula. That is what is called as Prorata Allotment. Now each share has a face value. In our example, I told you it's 100 rupees per share. Now the 100 rupees per share is called by the company. Now that since you have purchased the shares, company says, okay, per share that you have bought, pay us so much of money with a maximum of 100 rupees per share. That's a face value. Now some amount is taken while you apply for the shares, application money. Some amount is paid when the shares are allotted to you by the company. Alright. Now the amount which the company has called for and the shareholders have paid, which is known as paid up share capital. So if 100 rupees shares, company has called for 50 rupees and 1 lakh shareholders have paid 50 rupees, 1 lakh into 50, paid up share capital will be 50 lakh rupees. Whereas subscribed capital is 1 crore. Paid up capital is only 50 lakh, thousand rupees, 50 lakh rupees, because company has not called for more than 50 rupees per share. Alright. So 1 lakh share, 50 rupees becomes paid up capital, becomes 50. Yes, your doubt is right. Some of the shareholders may not pay. Though that portion is called unpaid capital, which is also called as a calls in arrears. That forms a very important aspect of our accounting treatment. We'll just take it up. So this we described as issuing shares generally to a public, the investors. But in a company's life, sometimes share capital are raised by issuing of shares to the existing shareholders. Suppose the company starts and it has allotted 1 lakh shares to say, let's say 10,000 people. On an average 10 rupees per share. So 1 lakh shares it has issued. It is the issued capital, subscribed capital, and let's say all of them have paid 100 rupees per share. So you have got 50 lakh rupees. So it is known as a paid up capital. Now company wants to raise another 1 lakh shares. That is 1 crore of rupees capital. The law says you must offer these 1 lakh shares to the existing shareholders in the same proportion that they were allotted previously. They are holding shares. Right. If someone is holding 5 shares, you must offer him 5 shares. If someone is holding 10 shares, you will be holding 10 shares, because earlier your subscribed capital was 1 lakh, now you are issuing 1 lakh, so 1:1 ratio you must offer. Now the person, the shareholder, may buy from you or may not buy. That is his right. That is why this is known as a right issue. Alright. If some shareholders do not buy it, left out shares, company can sell it in the public and, raise the capital to it, which it often does. Sometimes what is known as a bonus shares. Obviously, you could have understood that people buy shares to only earn an income. And that income, from the company's point of view, it is known as a dividend. Profit distributed among shareholders of a company is known as a dividend. It may distribute, it may not distribute. How much it distribute, everything is a decision of the company. Remember, when you pay dividend to the shareholders, what are you doing? You are giving cash. So instead of wasting liquidity of the company gives the shareholders additional shares as a bonus in place of dividend. The shareholders need not pay anything like right issue or the public issue. It is given as a bonus, free. So when shares are issued to the existing shareholders in lieu of dividends in cash, it is known as a bonus shares. It increases the share capital. Number of shares issued increases and the cash remains with it instead of giving to the company. And the last one, before a company starts, it requires various types of assets, machinery, building, different types of equipments. So instead of wasting liquidity cash, it buys certain property from the seller and tells the seller, look, we won't pay you cash, we will allot you shares. And the vendor accepts it because he knows that this will give me dividend in future. Right. So therefore, when shares are issued for considerations other than cash, it is issued, not bonus shares. They are not given. They are issued. Right issue is for cash. So it is the issue of share capital. All these things combined will become authorized capital, will become issued capital, will become subscribed capital, will also become paid up capital. So in a good company's balance sheet, if you see, these types of shares will be there. Now I'm briefly going to give you in 2 columns stages in the issue of share capital. Whenever a company issues shares to the public, the first term that you must remember is the price of the issue of the shares. At what price it issues. I have already introduced to you the term known as a face value. In our example, it was 100 rupees. Right? Now, if this 100 rupees share is like a commodity, if you understand, can be sold at 110, it can be sold at 98. If it is sold more than the face value, it means it is issued at a premium. If it is sold at the face value, it means the issue price is at par. And if it is issued at a price less than the face value, then it is called issued at a discount. So issue price can be three: issue at a par, issue at a premium, and issue at a discount. Obviously, premium received is a profit. It's not share capital. It is a capital profit. Share capital shall be only the face value. So if the shares are issued at a discount, say 98, you will receive 98 from the shareholders, but the share capital will be 100. You add this discount to the value and the share is holding is worth 100 rupees face value. Alright. So the discount and premium are totally different. Discount is a loss, premium is a profit. Face value remains the same. What is the price? If it is a discount, the price will be less. If it is a premium, it will be face value plus the profits. That is the premium. For each of these things, we have to make a different entries. Now, I have explained to you that through a document called a prospectus, company issues shares. It receives part of the face value at the application stage, called application money. Then it finds the allotment. Now, I told you that suppose the company issues 1 lakh shares and you get a subscription for 1.5 lakhs. It is a too popular company. So you cannot allot 1.5 lakh shares because your issued capital is only 1 lakh. So you have got to allot on a prorata basis, proportionate basis. What is the prorata formula? That is for the company to decide. Alright. The law also gives some guidelines how you must distribute and all. So suppose a person has applied for 100 shares and he gets 75 shares. He does not get 100 shares but 75 shares. So his application money will be for 100 shares you receive, but you are allotting him only 75 shares. So the balance 25 shares application money, either you can return or you can adjust against the allotment due on those 75 shares. Alright. So the prorata allotment, you have got to be careful in accounting treatment. That's how much is the proportionate rate. So based on that, how much each shareholder is applied and how much he is getting allotted. If there is any excess money, either it is returned or it is adjusted as usually done. It is adjusted as the allotment money. Even after adjustment, suppose for example a person has applied for 100 shares. He is allotted only 25 shares. So the allotment money will be still very less compared to the money received excess on 75 shares. So that money can be carried forward for calls on shares. So all these things requires a different accounting treatment. As I have explained to you in the PowerPoint that you are seeing on the screen, on the right hand side I have given the example for you to understand what I have said. Now let's come to the paid up capital. Once a person buys the shares, on each share he is supposed to pay the face value as and when the company asks. Out of 100 rupees, some money you pay as application money, some money you pay as allotment money, and some money you pay as a calls. The premium is not share capital. Premium is collected at the time of allotment itself. Company will never allow you to leave the premium. Alright. Now suppose you don't pay the share face value. Either because at the application stage it has no meaning. While you are applying, you must have paid the money. Alright. But at the time of allotment, a shareholder does not pay, or at the time of calls he does not pay. All these things becomes unpaid share capital. I told you paid up share capital, a portion not by the shareholders is unpaid share capital. Now, what the company says, it will not say that you please remain an unpaid shareholders. It will say either you pay you within this time with the interest or your shares shall be forfeited, will be taken back. Whatever the money you have paid will be the company's money and you will no more be a shareholder. This is allowed under the Companies Act. So this is known as a forfeiture of shares. Let us say for example, a person holding 1000 shares, he pays the application money of 20. he pays allotment money of 30 per share. So 50 per share he has paid on 1,000 shares. So 50,000 he has paid. When on the balance 50,000, the company asks him to pay 25 per share, which is roughly 25,000. He does not pay. So the company has received 50,000 shares. Company has called another 25 rupees per share. He is not paying. Company forfeit the shares after giving the notice. What does the forfeiture means? The money received from him, 50 rupees, is no more share capital. His shares are cancelled. That much 1,000 shares which he was holding will be cancelled, will be forfeited. And money received on those shares will become the property of the company. It's not a profit of the company. It will remain with the company. Why? Because the company will not keep quiet. It will reissue to some other person who is interested to buy. So after forfeiture of shares, they are reissued. Obviously, at the reissue, which is worth minimum 50 rupees. No, 50 rupees you have received, 50 rupees balance. You can reissue. It cannot be less than 50 issue price. It can be 50, 55, 60. So any money received beyond unpaid capital, that is 50 rupees in our example, will become a profit, capital profit in the hands of a company. So it can always reissue to the public and increase the share capital to that number of shares like earlier. But forfeiture of shares, the money received from them shall remain in an account called forfeiture accounts till the company reissues those shares.